Hi and welcome to the channel. So you have a week left. There's 1 week left until the end of the tax year. And the reason I'm saying this is because if you are paying into even a retirement annuity or you're paying into a tax-free savings account, your cutoff for the end of the year is the end of this month, which is the end of next week. So you have a week left to top up or try and max out your tax-free savings account for the year. At the current moment, the you can pay in 36,000 Rand a year. So if you haven't paid in 36, then obviously try and pay as much as you can until you get to before the 1st of March. As soon as you pay anything in on the 1st of March, it goes over to the next tax year. Okay, so, and if you've paid already the max in, if you're already at 36, then you have to wait until the 1st of March to make your next payment. So, why should you be paying in a tax-free savings account? Well, you get massive tax advantages with a tax-free savings account. It's after-tax money that you pay in. You have limits. Like I say, at the moment it's 36,000 Rand a year, and the lifetime limit is 500,000 Rand lifetime limit. Possibly that may increase with the budget on Wednesday. The lifetime limit may increase to 600,000, or maybe 550, but that's not a given. And possibly the monthly contributions, the yearly contributions may increase to from 36,000 possibly to 40,000. But let's see what happens. We'll see with the budget what happens there. So your tax-free savings account, your money grows tax-free. Same as a retirement annuity, the money grows tax-free in a retirement annuity. The difference is with your retirement annuity, you're getting a tax deduction on your contributions. So in other words, they minus that off your tax, and then you will get a tax refund, obviously depending on all your other income and everything from your tax. But a tax-free savings account is after-tax money, so you've already paid your tax on that money. You pay your money in, your money grows tax-free, and then when you take it out, and you can actually take it out at any time. Anytime you want to, you can take that money out, but it is advisable to leave it in until at least until you retire, or after retirement when you really need the money, because that money can grow tax-free for many years, and the longer it grows, then the more you will have at the end. So it's worthwhile to let it grow, and even if you have to take other money, rather take from somewhere else, like a brokerage account, for example, before you take from your tax-free, because your tax-free can then still grow. Okay, so what I worked on is you in retirement you can earn up to 12,351 Rand a month. This is now over age 65. Over age 65, you can earn that per month. In other words, 148,000 Rand a year before you actually pay any taxes. So on that amount, you pay zero tax. You've got an interest exemption of 34,500 if you're over 65. So in other words, you can have money in a fixed deposit or in bonds or whatever, and then also you've got a capital gains. Your capital gains, how that works is you've got a 40,000 Rand annual exclusion, and then after that your capital gain is obviously minus your base cost, which is what you paid for the asset, and then minus your for example shares or whatever, and then you minus that off the amount that you sell for. So in other words, let's say you buy shares for 20,000 and you sell them for 60,000, then the gain is 40,000 and the exclusion is 40,000, so there's zero tax payable. But obviously, if you have a higher capital gain, then obviously you pay capital gains tax on that. Okay, with a tax-free savings account, you don't pay any capital gains tax. It's nothing. No matter how much profit you make over the years, how much growth you have, nothing is taxable in your tax-free savings account. The interest you earn is not taxable. So you can have a nice portfolio there, growing tax-free, and like I say, when you take it out, it is tax-free. So you can take everything. Um, Dividends are also not taxed. Usually those are withholding tax. So it's really beneficial to have a tax-free savings account, and it's beneficial to max it out. And then when you get to retirement age, if you can max it out, let's say they do lift the limit to 600,000, and you pay in, it'll take you about plus minus 14 years to pay it if you pay the maximum every month and every year. So yeah, it'll take you about, I think it's about 14 years or 14 point something years, whatever. When you get to your max, by that time, if you use the rule of 72, your your money should have grown to at least over 1 million, possibly 1.5 million. And I mean, if you start really early, like in your 20s, you can grow to multi-millions. So obviously, the earlier you start, the better, but better late than never. So if you haven't opened a tax-free savings account, try and open one. Um, Try and open one, or try and add as much as you can, or try reach your max, but don't go over the max, because then you get penalized 41%. So yeah, max out your tax-free savings account. Use this last week to catch up if you're behind. Yeah, and then from next week, then the new tax year starts. Then your contributions start from zero for the year, and then you've got another year to pay in that. Like I say, it might that number might change. They might make it 40,000 for next year, but let's see what happens. We never know. Um, okay, all right. Okay, so pay into your tax free, max it out if you can, and yeah, you'll enjoy it when you get to retirement age. You will enjoy that capital and the dividends and stuff that you're gonna create, and all tax free. Thank you. Also, please note this is not financial advice in any way. It's financial education.